Welcome back to the vlog. Same book. Opening up to chapter. Hold on. Alright, so we're in the middle of chapter 7. Alright, so we're in the middle of chapter 7, trends and trend lines. And I honestly don't remember exactly where we left off at, so I'm going to just start from the top of trends and trend lines. All right, most technical analysis is rooted in market psychology at its core, and the idea of trends and trend lines is no exception. Groupthink is an interesting phenomenon whereby groups of people tend to stick together even if they are headed in the wrong direction. In the financial markets, many bubbles have been caused by this widespread belief that the masses can't be wrong. Okay. The U.S. housing bubble, for instance, was instigated by many professionals who claimed that the high prices of houses were justified by the demand for them, even though the demand was proven to be unstable during a rising number of defaults among borrowers. Trends in the financial markets are a consequence of this kind of groupthink. Even though the fundamentals of companies don't change very frequently, stocks often trend higher or lower based on the market perception over time. The increase in a stock's price leads to more buyers interested in catching the trend, which leads to further increases in price and continuation of the uptrend. While these trends eventually reverse direction, the momentum of the moves depends on the group's perception of what's in store for the future. For example, suppose that ACME, I think this is Acme Company, announces a new technology product that has consumers buzzing. After reporting strong first quarter results, the stock price may experience a sudden jump, followed by a trend higher over the ensuing months, even when no new information is released. The same company might miss analyst expectations during the second quarter, therefore altering the perception of the stock and sending prices lower. One of the most important phrases for day traders to remember is the trend is your friend. When markets are trading sideways, price action often looks random and is very difficult to predict. Trading prices present the best opportunities to profit as they are driven by an underlying confidence or lack thereof in a given market. Reversals for these trends too present equally attractive opportunities as the market reaction is likely to snowball. The tendency again circles back to the idea of groupthink. Trend lines are commonly used by technical analysts to determine whether a stock is trending higher or lower and to provide a clear sign as to when the trend is coming to an end. Uptrends are created by connecting a series of higher lows and higher highs with a continuous upward sloping trend line, which serves as a support level for the market. As seen in Figure 5, Apple Incorporated experiences an uptrend for about a half an hour. The price bounces off of an uptrend sloping trend line support. The price bounces off the upward sloping trend line support several times before breaking down through the trend line and beginning a potential downtrend. Each time the price reaches support, the day traders could determine a buying or selling opportunity. Downtrends are created by connecting a series of lower highs and lower lows in a downward sloping trend line, which serves as a resistance line for the market. And Figure 6, Apple Inc. experiences a downtrend that lasts the entire day. The price consistently bounces off the upper trend line resistance throughout the downtrend. In this case, the trend line is still active and won't officially end until the downward sloping trend line is broken through to the upside. Day traders will prefer to enter into short positions during this time, while potentially looking for a breakout of the trend line to confirm reversal. When a price is not in an uptrend or a downtrend, it is said to be in a state of congestion or consolidation. Congestion or consolidation occurs when a stock trades either below resistance, above support, or both at the same time. These sideways patterns indicate indecision in the market and make it difficult for technical analysts to predict where prices may be going. Oftentimes, day traders will avoid trading when there's too much indecision in the market, given the inability to predict the direction. The exception to this rule is when stocks are trading in a well-defined price channel and day traders can buy when the price hits support, and sell when it hits resistance. In Figure 7, there are many potentially profitable trading signals generated from these dynamics, even though the stock is not necessarily trending higher or lower. The problem is that these signals are not reliable as those going in the same direction as a prevailing long-term trend, and there's always a risk that the price could break out or break down. Okay, so this one is Figure 6. And I mean, basically, what are we seeing in this one? Okay, so essentially in Figure 6, we're looking at a downtrend. And so you can see how there's a point where it's higher and it begins to go downward. It bounces up and down as it's going down, but the trend line is continuously going in a downward slope. All right, and the next one is Figure 7, and this shows how a trend can bounce in a channel, and you can see how there's a period where it's hitting a very specific point at the top, and then it bounces down every single time it hits that point. And on the same token, within that same region, there is a support line, which every single time it hits that, it bounces straight back up to the resistance line within that channel. Okay. All right, where are we at? All right, so trends can be short-lived or last a longer time, depending on how long a day trader is watching them. A 52-week one-day chart may show a higher long-term trend, and a one-day, one-minute chart may show a lower short-term trend. Day traders focus primarily on short-term trends as they typically hold stock for only a day. Nonetheless, long-term trends are still important to consider if one wants to get a fuller picture. For example, a sudden decline that seems random on a one-minute chart could be attributed to a breakdown from a long-term upward trend line on a one-day chart. Day traders should keep an eye on trends occurring throughout multiple time frames in order to get the complete picture of prices where volatility is most likely to be seen. Facts. Support and resistance. The concepts of support and resistance form the cornerstone of technical analysis. Whether shown by trend lines or statistics, these key levels represent areas where prices are prone to reversals or breakouts. Support and resistance levels are primarily determined by supply, bears and sellers, and demand, bulls and buyers, dynamics in a given market. Day traders often watch for breakouts, breakdowns, rebounds, or bounces as a sign that that one side of the supply versus demand equation is taking control of the other. Basic support and resistance. Support and resistance levels are usually defined as horizontal trend lines that represent prices that haven't been exceeded after repeated attempts. However, the terms are often used interchangeably with any trend line that hasn't been broken after repeated attempts rather than just horizontal trend lines. Support levels are prices where demand is strong enough to prevent further price depreciation. As a price moves closer to a support level, buying picks up until it overtakes selling at or near the support level. These support levels can certainly be broken, of course, but history suggests that they remain intact more often than not, until a change in trend takes place. As a general rule, the strength of a support level depends on the number of times that the price has touched it and the volume and the subsequent rebounds from the levels. Resistance levels are prices where selling or supply pressure is great enough to prevent prices from rising any higher. I'll read that one more time. Resistance levels are prices where selling or supply pressure is great enough to prevent prices from rising any higher. As the price moves closer to the resistance level, selling pressure picks up until it overtakes buying pressure. Resistance levels can also be broken, but history suggests that they will remain intact. Just like support levels, the strength of a resistance level can be gauged by looking at how many times it has been touched by a price over time. The key point to remember when it comes to support and resistance levels is that when a support level is broken, it turns into a resistance level. And when a resistance level is broken, it turns into a support level. At the beginning of each day, day traders should plot these support and resistance levels and remain aware of them throughout the day trading. These levels are great for setting potential stop losses and take profit points for any trades placed. In addition to connecting highs and lows, support and resistance levels can be determined by connecting highs with lows in a horizontal line. Figure 8 demonstrates how a prior resistance level turned into a support level. After breaking through the $27 level, AAPL, bulls took over control from the bears, and the prior resistance turned into a support level. Bulls will struggle to defend the support level since a break could signal a trend reversal. All right, figure 8 as described. It's getting kind of dark, so forgive me. It's gonna get dark. All right. Round numbers represent other key areas of support and resistance since they are important psychological levels in the market. For instance, many traders have probably heard financial media pundits discussing whether a popular index will hold a certain level, such as 10,000 for the Dow Jones Industrial Average after a move higher. When prices rise to these levels, selling often intensifies as traders take profit off the table. Prices falling to round levels see the opposite occur, as traders take the opportunity to pick up the shares. Some day traders identify support and resistance levels at the beginning of the day and trade based on those levels as their exclusive strategy. For example, a day trader may identify a $10 support level and a $15 resistance level and focus on entering trades near the $10 and exiting them near the $15, using volume as a key indicator of trend strength. Support and resistance levels are restricted to single line or aren't restricted to single lines either. In some cases, day traders may identify support and resistance zones, which consist of rectangular areas where struggles between bulls and bears intensify. These zones can be identified by looking for concentrations of highs and lows that may be within a price range rather than a specific set price in general. While zones aren't quite as helpful when setting specific stop loss and take profit triggers, they do provide an indication of what to expect. Finally, day traders should be sure to look at multiple time frames when identifying support and resistance levels. While traders tend to use short-term charts for their daily trading, it's important to take into account any long-term support and resistance levels in order to avoid placing inopportune stop loss or take profit points. An example of whether this could be a problem is if a long-term resistance level exists before a short-term resistance level where a take profit is placed. In this case, the stock might prematurely reverse direction before the take profit level is hit, and ultimately cause a losing trade as the stop loss is triggered. Okay, advanced techniques. Support and resistance levels may also be calculated by using a pivot point, chart patterns, or even technical indicators, which adds to the complexity of technical analysis. By combining these various forms of analysis, day traders can identify the most significant areas of support and resistance to watch for a given asset or market. The biggest risk in including other techniques like these is drawing too many potential areas of support and resistance on one chart, thus making it impossible to make a decision. In Figure 9, day traders can see an example of daily pivot points and the index's movement relative to them. They may not be perfect at predicting areas of support and resistance, but they do provide a good indication of where these levels may lie. For example, the first day in February saw prices fall to S1 support, rebound to just above the pivot point, fall lower, and then rebound back above the pivot point just above R1 resistance. Popular support and resistance levels include pivot points. Actually, let's look at Figure 9 first. I think that there is enough light here. So if you can see, there's a bunch of lines. Those are all indicating support and resistance levels on different time frames, and so there's a large number of them as described. Okay. Popular support and resistance levels include pivot points. Pivot points are simple calculations based on the prior period's open, high, low, and close that are commonly used by all market technicians. Since they are so widely used, prices tend to react to them in a consistent manner. Chart patterns. Many chart patterns are designed to identify areas of support or resistance that are highlighted using trend lines. In addition to the basic levels, chart patterns provide some insight into when breakouts or breakdowns will occur. Technical indicators. Some technical indicators identify areas of support or resistance, such as Bollinger Bands and where upper and lower trend lines exist, where others simply provide an indication of when prices are too high or too low. When it comes to generating trends, trading signals, day traders will look towards support levels for buying opportunities and resistance levels for selling opportunities. These dynamics are similar to the buy low, sell high saying, an expression popular in financial circles. While some moves below support or above resistance levels may become breakouts or breakdowns, traders should be aware of the potential for false breakouts where the moves are merely temporary. All right, cool. I think we'll stop there, and when we come back, we'll read about how to connect the dots and kind of how to put everything together. So basically connecting all the dots to the big picture. Okay, got a little dark out there, but we are going to conclude the video right there. When we return, we'll talk about connecting the dots so that we can put the bigger picture together and understand how to look at a chart on both larger time frames and also on smaller time frames, and how to put that together to make it make sense so that you get winning trades and so that it doesn't just look confusing and it's all over the place. So see you next time.